Welcome to Truflation.com AMA, and welcome to our many listeners around the world. We appreciate you joining us today. Our guest is Danielle DiMartino Booth, noted economist and former Fed insider who heads QI Research. That's Quill Intelligence, QUILL Intelligence.com. She's also a contrarian, a basically unafraid to follow the data where it leads. And somehow that put her in the Truflation orbit. And so today we're excited to pepper her with questions about the Fed policy, the U.S. economy, inflation, and where she sees things headed. Before we do that, some light housekeeping, a little bit of vamping as people kind of make their way in here. We are, of course, sponsored by Truflation Premium, a granular look at financial data for businesses, investors, and those who wish to stay in the know. So surf over to Truflation.com and click the black download data button for pricing and plans. We're also all over social. So if you go to Discord, Telegram, LinkedIn, YouTube, and of course Twitter, we are there. In the meantime, we want you to ask questions of Danielle DiMartino Booth. We've got her up here in just a second, and you can do that a couple of different ways. One is you can press the request to speak button, and we'll put you right up online so you can ask her a question. Or if you'd rather not do it verbally, you can always at us on Twitter, and we'll get that question to you right away. When we do bring you up as a speaker, so you request to speak or we request you, do us a favor, and once you're up in line here, mute yourself until we throw to you. That way, we don't get any background noise and all that good stuff. So go ahead and do that. In any case, we are again very excited to have her. It's Danielle DiMartino Booth. It's been a long time coming. We've had a kind of a mutual admiration society. Thanks so much, Danielle, for coming on.
I'm so pumped up to be here. So happy to be here.
And we're happy to have you. I'm still kind of wondering, how this happened. And before I get into all of that, I think, especially in the digital age, people are kind of skeptical about how, different factions kind of find each other. And I can't stress more that this is so organic, it's unreal. But before we do that, in case people are unfamiliar with you and your background, can you kind of enlighten them a little bit?
So I started off on Wall Street at a firm that is no longer with us called Donaldson, Lufkin and Jenrette. Tony James sold the firm at the peak of the dot-com bubble to Credit Suisse, which, believe it or not, lost billions of dollars on the purchase. After I was there during the dot-com bomb, I learned a lot about private equity when I was there, which was fabulous. We had a merchant bank. We were private equity before it was. Stephen Schwartzman started at DLJ. In any event, that was a great experience. When I left, I signed a non-compete. I agreed to leave the business, and I got my first master's is an MBA in finance, international business, and my second was from Columbia University in journalism. So I signed a non-compete, agreed to leave the industry, called up the publisher of the Dallas Morning News. I knew I was leaving New York, moving to Dallas, said I'll work for free. He said that works great with my budget. So I was kind of the oldest unpaid intern they'd ever had, and it was great. Within 6 months, I had a daily column, which was unheard of, mainly because people in the newspaper industry are not productive. And Warren Buffett ended up inviting me out to Omaha. I had so much fun hanging out with Charlie Munger. He was a huge influence. I had written about the dangers of China buying too many U.S. treasuries. And they're like, wow, Warren Buffett was like, that's kind of far out there. Well, it certainly was in 2004. These things do come home to roost. The next person who found me was Richard Fisher. I ended up working at the Dallas Federal Reserve as one of his advisors for the better part of the financial crisis, 9 years, advising him on kind of the intersection of unconventional monetary policy. Quantitative easing was born when I was inside. zero interest rate policy was born when I was on the inside. But advising him on how monetary policy interplayed with the financial markets. So when Richard retired in 2015, I followed him into retirement. QI Research was born 7 days later. I've published ever since then. And now we've got 13 separate publications a week at QI Research. We've got institutional investors who are our clients. We have a very exciting Bloomberg chat room that goes with it, in a private Twitter feed of all things. And then I've got a huge pool of retail clients who read the Daily Feather as well. It's a Substack publication, and that's become kind of a cult following of mine. I am the ultimate contrarian. Once you work inside of an investment bank with compliance, and then it gets even worse, working inside of a bureaucracy like the Federal Reserve with all kinds of security measures and sensitivity training. I'm not sensitive. You end up saying, I will never, ever conform again. So I have never conformed again. So I'm the ultimate contrarian on Wall Street, and I love what I do.
You can tell, and I think it's safe to say, and hopefully we're the first to call you this, and this sticks. But you are the James Brown of the financial world. You're the hardest working woman in show business. You're everywhere.
Well,
It is amazing.
I mean, look, when I left the Fed, one of the things that horrified me was the lack of understanding of your average American, just your lack of financial acuity, the financial illiteracy was just astounding to me. So it became a mission of mine to kind of be everywhere and to take the mission of financial literacy to heart. That was what writing Fed Up was all about. First time authors don't make money on books, FYI. And I got a very nice, for a first time author, I got a very nice chunk of change from Random House. But that's not why I wrote Fed Up. I really wanted to spread the word, and people say that my Twitter feed is a free MBA. Nothing could make me any happier than hearing those words.
Yeah, that's very cool. We're gonna ask you about Fed Up because that's where I think I first heard you, through some of the crankier outlets like Mises Institute and so on. Those early podcasts, those were it was yeah. I definitely remembered you from there. But this kind of brings us to exactly where I wanted to be at this point in the conversation, which is how the heck did you find Truflation? What are your thoughts on it? And I'll just leave it there. How do you come about us?
Well, I didn't. In my Truflation came to me inside of my Bloomberg chat room, and there's a lot of fixed income traders in there, and when you're being sold a bill of goods, and the
Hmm.
frustration around the official CPI data among fixed income traders was just it was a thing. And I'm talking about 12 months ago is the first time somebody uttered, have you looked into this Truflation? It looks like real time data, blah blah blah. It looks like it's kind of a clean methodology. And I'm like, never heard of him, move on. But then I got more and more and more. Have you seen how high Truflation is? It's higher than the CPI. So I'm kind of paying attention, and then it starts to come down at about the same rate that I'm seeing prices fall, as opposed to so many of the lagged effects in the construct of the CPI. And it was just critical mass. There were too many people who were saying, you have to put this on your radar. So I did. And spoiler alert, I begged, pleaded on bended knee for the hard data, because I had to know. I had a friend trashing Truflation a few weeks ago, won't name him. Zero correlation. And I'm like, zero correlation? That's a really big number. Zero is a big number when you're talking about correlation that runs between 0 and 100 being perfect, zero being they have nothing to do with one another. So I'll let you ask me the question before just spilling my beans.
Yeah. So what? Um, so just for people who aren't kind of following, we reach out to Danielle for to come on, and she says great, and she's kind of preparing and getting ready for a Twitter Spaces, and she goes, oh, by the by, maybe I should kind of dive deeper into Truflation's methodology and so on. So we get that out to her, and then she comes back with some pretty interesting results, right?
Well, I wouldn't call them interesting. I would call them unequivocal in economic speak. That's what a 97% correlation is. Ain't no gray area there. Truflation's telling you where the CPI is going. It's not telling you with any kind of disclaimers. It's simply telling you.
Boom.
Boom.
Yeah, I'd rather you said that. And that's a nice segue to our CEO who I want to bring in here, who is Stefan Rust. I'll make the introduction formally here. Stefan, Danielle DiMartino Booth, DDB, Stefan Rust.
Yeah, nice.
Pleasure.
Yeah, pleasure's all mine. Thank you very much, and really great to hear that attestation and confirmation of what we're doing. Yeah, a lot of we've received a lot of criticism as well. People want us to track what the government is reporting and the BLS's numbers, and we just feel that's not in touch anymore with the reality. And if you do extract certain elements out of it, you do get that correlation that you have. And so super excited to get that quote, and yeah,
Well, I
and
mean,
just the
what's
confirmation.
interesting to me in terms of the basis of the criticism
Yeah.
is that markets are supposed to be forward looking. So why be critical of something that looks backwards? Why wouldn't you want to know, to use the most overused cliche on planet Earth, why wouldn't you want to be Wayne Gretzky and know where the puck is going?
Yeah, I mean, but unfortunately, everybody just wants to sort of track you exactly to what the metric is that's going to be exactly what the government reports. And yeah, I mean, yeah, and we just don't do that. We refuse to do that because we just don't believe that's where it's going and where the reality is. So yeah,
But
just
I mean,
simple as that.
if you look at right now, the body of deflationary evidence right now is nothing that I've seen in my career. Nothing.
Yeah,
I was too young. I was too young to a report that came out today from the Bureau of Labor Statistics. I'm going to read you something very quickly.
yeah,
U.S. export prices to Mexico decreased 16.7% from June 2022 to June 2023.
yeah.
It goes through this litany of all these countries where they're seeing year over year record levels of deflation in data back to September 1984. It's 39-year-old data, and they don't have a single
Wow.
precedent. Industrial metals, that's one of the biggest calls we've had at QI, is get the hell out of the way of Goldman Sachs' idea of some commodity super cycle. If China's not going to pick itself back up, and it's not,
No.
then industrial metals are not where you want to be. And I just saw a Bloomberg headline go by right now. Industrial metals are melting. We told our clients about that 18 months ago. We're like, don't buy this super cycle China reopening thing. It's just not happening. When India figures out how to bring in outside investors in a big way with a good demographic population, then you're going to see industrial metals take
Take
off.
off. Yeah.
But you're not going to see it right now in the current construct.
I mean, I feel largely a lot of, I mean, number one is what we do is trying to bring real-time metrics as close to reality as we possibly can, and then add in there sort of lead economic indicators like you're just announcing and mentioning. But I just largely also feel that the Federal Reserves and the central bankers around the world are just enjoying the limelight right now, and they want to stay in that limelight. They don't want it going away from them. They're just loving the fact that they're allowing people to choose the color of their currency in Europe, right? They are loving the fact that every time they go on stage, audience, just comes to a standstill. They've got full rooms. They're just enjoying the glory at the moment, and they don't want to change that. And so they're doing everything to extend that limelight, no matter what, and regardless of the consequences to an economy.
You are absolutely right, and I cannot come to the defense of other countries necessarily. I can. I mean, look, retail sales in France just went bonk. They just fell off a cliff.
Yeah.
I'm like, hey guys, Europe's going to have a disinflationary problem real soon here too. But I can't be critical of other central bankers because I haven't studied them as closely as I have um,
In
as
the
I have
US.
Jay Powell. Jay Powell understands that it was a matter of national security that the long bonds stopped trading in the middle of the night in March 2020. He gets it.
Yeah.
He understands that the Fed's footprint in the treasury market is simply too big at 8 trillion. 9 trillion almost. Now we're down to 7.8 trillion. Okay. But he understands that it needs to get closer to 5 trillion, given, where the national debt is right now, given the trajectory of national of the deficit. He understands that he needs to reduce the size of the Fed's balance sheet to restore the sanctity of the risk-free asset. I just said a lot right there. But if you want to boil it down to limelight, we can. He's never liked the limelight. But what he does want to do is find any excuse that he can to continue shrinking the balance sheet. Even if it means waking up in the middle of the night and going, I know, it's not in Haver Analytics, but let's invent super core inflation. And we'll take the core PCE and we'll net shelter out of that. And historically speaking, it's never contracted. So we'll reset the market sights on something that's infallible, that cannot go negative, even though, hello, it printed negative last month. But 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 he's looking for any excuse that he can find to continue shrinking the Fed's balance sheet as quietly as possible. Every day you see the stock market is up, he has license to continue shrinking that balance sheet. He'll hide behind anything he can, including fake inflation data, including fake job openings data. He'll hide behind all of it to continue on his path.
That was something I heard you mention in another context. You were talking a little bit about this, or maybe it was posed to you. I can't quite remember the exact scenario, but um, the paradox at this point, and I just actually read it in the New York Times this morning. Really interesting column that was sort of cheerleading Bidenomics, but essentially they're saying, or the paradox is, the stock market's up, and yet we are where we are. And you had a really interesting observation, and you might have already just kind of said it, but why is the stock market continuing to rise even though we might be going where we're going?
So, something that we studied pretty closely when I was a Fed insider was the whole idea of animal spirits. Now, you have probably 90% of people on Twitter believe that discount window lending and that the Fed's facility that it rolled out that guaranteed 100 cents on the dollar for underwater treasuries and mortgage-backed securities, about 90% of the people on Twitter believe that those were forms of quantitative easing. Now, they weren't, but it doesn't matter. They believe that. So that's why you're seeing retail trading as high as it is right now. And in addition to that, the United States government, the fiscal authorities, are quietly pumping $30 billion into the US economy every single month in fiscal relief that came out of the CARES Act and was extended by Biden's first stimulus plan. I'm literally staring at the data right now at the current run rate. I mean, I wish we could all raise our hands, right? Who's heard the jingle for getrefunds.com? A lot of us have. But at the current run rate, the employee retention credit will pump $33.2 billion into the U.S. economy in the month of July alone. And it's been doing this really since July of 2020, but at increasing numbers as the fraud grows and everybody responds to these tax outfits that the IRS is trying to chase down at this point. Now they know the fraud's out, but it doesn't matter. They have found a massive loophole in the tax code to bilk the U.S. taxpayer. So in addition to animal spirits, in addition to record levels of credit card spending, despite the fact that business investment is contracting, right? You want to add up in a 70% economy, 70% consumption. That incorporates what businesses are spending, what households are spending. But you want to be able to parse out what business investment is declining, but people are taking billions of dollars out of their home, cash out refinancings, 8-9% levels for these home equity lines of credit. It doesn't matter, it's money. So at the same time that you have fiscal stimulus pumping through the U.S. economy, filling up first-class cabins, just like the CEO of Delta Airlines said a few days ago, right? International travel up 60%, domestic up 8%. So people, high net worth individuals, are receiving these tax refunds money, and they're putting the dog, mom, the sister-in-law that they don't even like, all the kids. They're all in the front of the bus. They're all traveling to Paris. Bank of America proprietary data shows us that brick and mortar spending by Americans at luxury shops in Europe is off the Richter scale, running at record levels. So Uncle Sam is in large part maintaining the US economy. And all you hear from Wall Street is we just don't understand why the recession's not here. And I'm like, because money's money. And in a 70% consumption economy, all that matters is where your next marginal dollars coming from. Meanwhile, back at the ranch, you've had food stamps pulled out. You're seeing food inflation begin to decline. Food, by the way, is twice the weight inside the CPI as energy. And you're seeing rents come down. The Cleveland Fed measure of repeat renters turned negative last month after going parabolic. It's more than round tripped and is now negative. Rental and shelter inflation is 4 times the weight of healthcare inflation, and you're seeing that play out in real time in Truflation.
I was just in Paris, and so I can totally attest to that fact that the shops and I mean Americans everywhere shopping in Paris and spending a lot of money. But one of the
Well,
things.
they're spending my taxpayer dollars. Thank you.
Yeah. Sorry to say that, but yeah, I can only confirm that. And yeah, I mean Paris is booming though. That I can say. I mean it was really hustling. Lots of people, lots of tourists. It's like there's I mean, nobody sees the writing on the wall. I mean, the debt's growing everywhere, and that's money's coming from somewhere. The labor market isn't changing. I mean, we have a 0.1% drop, which was recorded, the official number. Salaries are going up, continuing to go up, and where is this going? Do you think that this will ever come to a stop? Do you think that everybody thinks that we're bringing more factories onshore, everything's going to be onshored, the manufacturing capabilities are going to remain labor intensive, which I don't think so, right? They're all going to become
Well, they're not.
robotic, right? They're going to be automated.
No, they're not labor intensive. They haven't been labor intensive for generations, plural.
Exactly. So those aren't going to create the new jobs. Where are those new jobs going to be created? How are they going to be created? And where, how is this going to actually benefit the economy with AI coming out, with more and more services and productivity going to be increased per individual? What does that mean for the general population?
It means a lot of stagnancy going
Yeah,
forward. And I don't think that people, I mean, look, Chris
stagnation.
Williamson, he's chief economist at ISM. He's a pretty happy go lucky guy. So for him to say 2 months ago, if we don't start to see expanding backlogs, and backlogs are just future demand, right? But if backlogs don't pull out of their record run of contraction, the second quarter earnings season is going to be one manufacturer after another announcing layoffs because they can't justify having the laborers that they do have on staff. Well, okay, fine, Danielle. Is Ford building a $1.5 billion electric vehicle company? Yes,
Yeah.
it is. It's called the Inflation Reduction Act, and it's pumping stupid money into the economy. But if you look at Dodge construction data, it tells you that whether it's residential real estate or it's private non-residential, you're seeing those numbers contract year over year. So there's very little in the way to sustain going forward outside of what Uncle Sam's going to spend. And by the way, Uncle Sam's going to attach ESG and DEI and all
Yeah,
these other
exactly.
stupid acronyms to the spending, which is un-American. But other than that, at some point you're gonna get down to the only game in town. Look, the freight industry was excited at the prospect of Yellow going bankrupt. They're like, good, we need to take capacity out of the system because freight prices keep falling.
And
So
what
if,
does
if
that
Yellow
mean then
goes,
for the small, medium businesses, the entrepreneurs, the
well,
the small family-run businesses or community-run businesses that are trying to make ends meet, keep people hired? How are they going to struggle through this? Because they're not the first in line. It goes to Ford, it goes to GM, but it doesn't come to the little supplier that's creating the widgets that feed into the car manufacturing plants and stuff like that.
no, it doesn't. I've just spent the last 2 months in Indiana. As a percentage of its gross state product, Indiana has the highest intensity of manufacturing, 38%. of gross state product. Of course, Elkhart, Indiana is right there where you make RVs. The cliche is true. But, being in a small town, people talk to you in small towns and they tell you things like, gee, my son just lost his job because the factory closed down the road. And these are smaller factories that feed larger factories. And it's a real fact of life. I follow dailyjobcuts.com very closely. Why? Because it shows me that HarperCollins just shut down a printing press. And it shows me that all of the small businesses that continue to go out of business on a day-to-day basis. So far in July, 128 major closings plus 150 Walgreens stores plus 100 Bye Bye Baby stores. Rite Aid looks like it's going to follow. Retail's a complete you-know-what show. But people don't pay attention to that. They pay attention to the fact that, oh, look, Ford's building an EV plant. Oh, and by the way, they might be downgraded again. They're going to be the most downgraded company in U.S. history, a serial downgrade company, because they're losing money on it.
You're listening to Truflation.com AMA with Danielle DiMartino Booth of QI Research. You can find pretty much everything she does out at quillintelligence.com. That's QUILL intelligence.com. We want your questions too, listeners. We have listeners all over the world. We've got about 5 or so in the queue here, but as we continue to kind of selfishly ask Danielle some questions on our end, keep stacking them up because in a little while we'll forward. And if you want to ask her personally, just request to speak, and we'll move you up in the queue as well. So having your I guess background and writing fed up, I think it's only fair to kind of ask you. Um, so next week is the FOMC, and before I get into your sort of predictive capabilities here, can you explain just a kind of a high level insider's take as to the machinations of the FOMC rather, and how it kind of operates? Because you said something really interesting, which I haven't seen highlighted, is that they're now, and you ferreted this out in a couple different ways, but you were paying attention to Powell's verbiage, and how he was saying consensus was arrived at, and you pointed to 3 dissenters, and I think a lot of people sort of see the FOMC as Powell, and they don't kind of get the inner dynamics. Anyway, that was a long way to go. Can you kind of give us a high level insider's look at what the FOMC might be doing next week?
So I think that for the moment, at least, because Mary Daly of the San Francisco Fed has been pretty hawkish in her public commentary prior to blackout. So if she in San Francisco Fed is usually considered to be the most dovish, there's an ongoing competition to see between the Chicago Fed and the San Francisco Fed who can be more dovish. You can tell that Austin Goolsbee, the newly appointed head of the Chicago Fed, you can tell that he's itching to dissent. But for the moment, I think Jay Powell continues to control the narrative enough. And what that means is I expect another full consensus and no dissenters in July, despite the fact that if you looked at the dot plot, you can tell who the individuals are who do not want for the Fed to raise interest rates again. And as a former insider, it's an interesting leadership role that Jay Powell Esquire is playing, because his predecessors, Greenspan, Bernanke, Yellen, they all kind of took the macroeconomic portion of monetary policy much more seriously because they were lifetime academics themselves, PhDs in economics. Paul Volcker, bless him. Usually when I say bless your heart on Twitter, I'm not really just substitute the word bless for something not as nice. But seriously, bless the soul. May you rest in peace, Paul Volcker. He used to drag in the economists and talk down the Phillips curve, force them to sit in a conference room. God love the man from New York. But he was the last person who didn't really give a rat's you-know-what about what the market thought about Fed policy. He was followed by a bunch of academics who every FOMC meeting, you really would drill down into the econometrics of it. And that's not who Jay Powell is. However, you have to give these people voice. You have to give the Fed staffers their chance to shine, and have their say. But the pragmatist, Jay Powell, knows that he just needs to shrink the size of the Fed's balance sheet. So they can say whatever they want as long, and they can do as many presentations as they want about hedonics and the efficacy of the jolts and whatever else they're presenting, because that's why what else are you going to do with 800 PhDs? They've got to do something. They sure as hell aren't going to help you make monetary policy, but you got to keep them busy. It's bureaucracy. Used to work there. So, but in the end, all he needs to do is kind of play Obi-Wan. He just needs to, despite their dovish leanings, just continue to say, these are not the droids you're looking for. We must continue to tighten policy. These are not the droids you're looking for. We must continue, and we must have a united front, because the Fed is independent, even though everybody inside the Fed knows the Fed's not independent. But it sounds good, and you can never deny it out loud. That's a big no-no. So as long as he maintains that unified front, then on July the 27th, if he so chooses, he can say, okay, how are we going to switch the market's narrative again? We've been doing this successfully since January 2022, right? How are we going to start shifting pricing of a rate hike in September if that's what I want? And that's kind of how it's working right now. It's a different Fed.
Hmm. And so, do you believe you kind of just answered it, but do you believe the Fed will hike this time around?
You mean on Wednesday?
Yeah.
Yes. Yes. No, the Fed, whatever your market pricing probability is, unless there's a Timmy leak in between, which you can only use those sparingly, but whatever Fed pricing is when you go into blackout, which is a week ago, week ago today, that's what dictates whether or not there'll be a hike or a cut or what. So, I mean, we're at like 100% right now, practically 90 something percent, according to the CME. The Fed, and certainly not Jay Powell, world's most balanced Fed chair, he's not going to surprise the markets.
Yeah. What's
You
your
know,
view, Danielle? Just a quick question, just out of that, right?
Mhm.
So interest rates have been going up significantly. We're trying to onshore a lot of manufacturing, build out investment, but the cost of capital as we deploy and build out infrastructure and invest in new opportunities, new manufacturing capabilities, that cost of capital to do that is getting more expensive, obviously, as the interest rates go up. How do you see that impacting the economy going forward? Is that an impact at all, or we don't care because we've got all these acts that are supplying capital? What's your view on that?
So wherever that silo exists, where you're mandated to hire unionized employees, so therefore, going in that by law your IRR can be crap. So outside of that silo, um, of kind of government stimulated investing, you're not hearing
Yeah.
about any kind of loosening in lending standards. You're hearing the exact opposite, right? Very quietly, you've got commercial and industrial lending contracting. It's nice and quiet. Let's keep it quiet. But you're not seeing fresh capital get deployed. In fact, you're not even seeing transacting in the middle of any market. You see leverage loans rush to market the minute there's a window that opens, and then they rush back out the minute that window closes. But you're not seeing, you're seeing trophy properties change hands. You're seeing trash properties get handed back. But anything in the middle, whether it's including housing, by the way,
Yeah.
you're not seeing transacting in housing. You're seeing transacting. John Thane just sold his fabulous apartment in Manhattan for a loss. $17 million after however many years, adjusted for inflation, and he really lost his hiney. But you're seeing trophy properties and you're seeing trash get handed back. But other than that, you're not seeing, even in corporate bonds, you're seeing preemptive Chapter 11 filings,
But
because they know
isn't that a
that there's
problem
no way
for
to
us?
refinance.
Sorry, but
Sorry.
isn't that a problem for us if we got more money going to money market funds than actually going to build out productivity, growth, and drive capital, which will hopefully then generate tax income, which will then service some of the debt that we have, etc. I mean, how do we change that, and what is the repercussions of that going to be?
Oh gosh, I mean the repercussions could be very political in nature, right? If you continue to eviscerate productivity, you could easily have a blue wave come election day because people don't want to work, and if there also is no work, then you're just going to vote in getting paid to not work, and then then Truflation goes the other way. It hockey sticks north.
Yeah, I mean that's my fear, right? I mean we've lost the ability to realize what it means to go back to work and sweat, pull up our sleeves, dig deep. And I don't think we're going to see a quick turnaround. I think this is going to go through a next couple of years where we've actually got to really pull up the sleeves and dig deep and just hustle through it. And we can't sit back and imagine that China is not going to work through this. They're not going to bully through this. They're not going to try and hustle their way through this in a very different modus than the way we would. But just, I don't know. I just feel that we're going to need to, yeah, just pull out, get to work. And
Oh yeah,
I,
look, I mean, it's the mindset of so many young Americans. I mean, somebody just posted up there in a very blasé fashion today. Somebody posted something about all this credit card debt being run up and savings being run down, and just the regular old blasé answer is, oh, they'll just walk away from their credit card debts. And I'm like, but that captures the zeitgeist. It captures
yeah,
this nihilism. We'll just let the government take care of it. It's not a big deal. So I mean, I did my part this summer. My baby, who's 15 years old, it's only 109 degrees in Dallas, but he worked in the warehouse all. Some might call that child abuse. I really don't care. He has a much better appreciation for what a minimum wage is, working in a warehouse when it's 109 degrees. So I'm going to continue to do my part, and I hope real Americans continue to do theirs, because what made this country great was our work
definitely.
ethic. And I think, over in Beijing, I think they're like laughing their heads off that America's trying to become China and live off the state, while they've got their workers at gunpoint, going, get back in the office, go back to.
You're listening to Danielle DiMartino Booth, part-time stand-up comedian and full-time badass.
My mother
She's
my mother tells me sometimes that I don't have a filter. I don't know what she's talking about.
You can find more of Danielle at quillintelligence.com, Quill intelligence.com. And you're, of course, listening to Truflations.com's AMA with Danielle. If you've got questions, we want you here. And it looks like our first speaker is Universal Dividend for Danielle DiMartino Booth. Universal, what say you? You have to, there you go.
Yeah, I posted my question there in the comment thread. Um, really just trying to engage a conversation in the community about, you know, what we're going to do about AI taking away people's jobs, and, how we might possibly do that in a way that doesn't involve taxes.
You mean taxing employers who are destroying jobs? Did I?
I mean, essentially, in a roundabout way, yes, the the employees that are taking away your jobs will be AI agents. So the companies that will be laying off thousands of workers will be replacing those workers with AI agents. And uh, you know what what is everyone going to do? What kind of jobs are they going to take?
That's look, AI is supposed to be. Its proponents are saying that AI is job accretive in the end. I mean, but I mean, in the end, we're all dead too, right? But
That's right.
so I don't. I haven't really studied the politics and the idea of taxation. What I can tell you is that when you look at individual entities and their lobbying presence on Capitol Hill, that there's something of a farce that goes on every few months, right? You haul Mark Zuckerberg up in front of Congress, and you grill him and you tell him he's a bad person and that monopolies are not American, and then you take all of his lobbying money and say, thank you, I'll see you again in 6 months, and nothing happens. So my greatest concern is that after the National Association of Realtors, of course, the largest lobby on the planet, largest spending entity, lobbying entity on the Hill, that after that, you get to Silicon Valley really quickly, and they're the ones that are going to benefit the most. So my concern is that we'll get a lot of talk out of Washington, D.C., and not a lot of action. I know that would be out of character for our politicians. They're very much go-getters. They accomplish things. They're productive. They're efficient. They don't spend too much money, but be a first. But I'm concerned that the lobbyists will win this battle.
Exactly right. So the idea that I'm kind of workshopping here on Twitter and doing as an open conversation, and it's kind of relevant to what you're saying. That's why I'm kind of here. Is kind of the idea of we, the people, kind of taking it in our own hands and, solving the problem ourselves voluntarily.
That sounds great. I hope it can happen. I'm a bit cynical, so I apologize, in advance. I'm concerned about the path that the country's taken when jobs have been lost in recent episodes. Very concerned about it.
But
Great question. Go ahead.
yeah, but I do think, just coming back to the AI story, we've moved on from a sort of an industrial agricultural age to an industrial age to now sort of an information age, and we're all sort of pretty comfortable working behind desks from our home. And I think, Danielle, you mentioned it earlier, right? Do we want to go back to hard work? I mean, I don't think we do. And I think AI has offered a tooling, and I don't think there's a way to, the cat's out of the bag. I don't think we can put it back in, right? And I think everybody's beginning to realize it. So we need to leverage the tools that AI offer and make sure that it stays open. You can have different opinions and build a competitive environment around that so that we ensure that the input going into these AI engines have a diverse set of opinions so that the output isn't biased towards one or the other side, and then that we learn as a civilization, or as a community, or as Americans, how to work with that data and how to use the tools that are going to come out with this, because there will be new jobs coming out of this. There will be people that learn how to give better input, that create many more outputs for the same type of input. And I think that's going to be really important. How do we foster that? How do we harness that? That is totally undecided.
I mean, look, if you think about what has held back American productivity for generations, you come down to teachers' unions, my personal opinion. If you think about how AI could level the public education playing field in America and bring the best education money can buy to everybody, that's insane. I mean, the possibilities are endless if you have a better educated society, and you can, and the reach is universal. That's what made America great in the first place.
100%.
So if we go at this the right way, and you're right, some of the things, the biases that are being thrown out by AI are frightening. So you're right, we have to have all sides of every argument, and every bit of analysis go in, such that you're not killing contrarianism. But if we harness this in the right way, this could be amazing.
All right. So you are listening to Truflation AMA with Danielle DiMartino Booth. We've got a question here from Euro Dollar Don. EDD, you are up, my friend.
Thank you guys for having me. So if you don't mind, I'm kind of just gonna ask it's kind of a couple questions, but they all relate, and you're welcome to not answer any of them or answer one of them or a couple of them if that's okay. So I wanted to say shadow banking system to me from what I've observed, seemed to play a bigger role in lending and therefore the economy for a long time, pre-2007 and 2008. How large do you think the shadow lending market plays in today's global and maybe also the U.S. environment? Do you have any resources to track that information and data related to those topics? I don't know if you have any thoughts on the transfer from LIBOR to SOFR, as well as I don't know if you have any thoughts on how much really reserves affect the banking system as compared to as much fiscal policy and private banking or financial balance sheet expansion. Thank you.
So I've done extensive. Did I mention at DLJ we had a merchant bank? So I was around private equity before it was a thing. If you can imagine, Timothy Geithner, when he was head of the New York Fed before the crisis, took note of the fact that in the United States, at least, the unconventional banking system, that's the words he used at the time, was $17 trillion, and the conventional banking system was, I think, $10 trillion at the time, and that might be problematic. So file those numbers in your head. Today, $240 trillion is what the global non-banking system is. $240 trillion. The conventional banking system globally is $180 trillion. Only one of the two, the much smaller, is regulated in any way. The BIS, World Bank, the hugest entities on the planet track these figures. But I follow them very closely because although Silicon Valley Bank was a big regulatory disaster, right? The head of Silicon Valley Bank should have never been able to lobby to not be regulated and go play cowboy and sit on the San Francisco Board of Directors. And that was all not good. By the same token, Jamie Dimon has a point. If you regulate even more the conventional banks that are $180 trillion, then you're going to give more power yet to the non-banking system that's $240 trillion and growing and doesn't have to play by any rules. Now, the good news is that Jay Powell understands this dynamic and knows that the majority of the business models in the non-banking world are predicated on zero interest rate policy and hyper leverage. So the longer he manages to achieve higher for longer, the more we can maintain an ample reserve regime, and it sounds like you know exactly what I just said, then the harder it's going to be for the non-bank system to not begin to atrophy because its business model simply does not work in a normalized interest rate environment. LIBOR, SOFR, I think we eventually transition. I think if we were going to have seen Armageddon, we would have already. But I think the bigger picture is you've got your eye on the right ball, and I hope that regulators. Am I placing hope in Janet Yellen? Good God. It's only like midday, but I need a drink saying that. But I hope that regulators understand the import of Blackstone having $1 trillion of assets under management and not being regulated and not paying the same taxes. So with any luck, if anything that Jay Powell accomplishes, it's not giving more power over to what I call the kingpins of finance and making sure that conventional banks that used to know how to lend are able to actually competitively continue to lend going forward. So
We've got Danielle for maybe another 10 minutes or so. So I'm going to try to get through as many questions as we can. She's been extremely generous with her time today, and we certainly do appreciate it. If you want to know more about Danielle and her work, head over to quillintelligence.com, QUILL
and also
intelligence.com. Yeah.
shameful plug, I have moved to that old Substack platform, so dmartinobooth.substack.com, and that's also going to give you some samples. It's nice samples of the writing as well that we pump out every day.
We got a preview of the quill, or the feather rather, and that's some dense stuff. I mean, you're not being cheated at all. There is no fat in that
No,
that letter.
and actually, my Trieste is too small to not fail. There's no payroll around that thing. So anybody who, most of my followers on Twitter read it, because it's rare that I put something out there that's that big and bold. But the whole reason was it was just too important to keep behind a paywall. So if you have not read Too Small to Not Fail, please go and find that. Google it. You'll go right to it.
Very good. Next up is kudos for the handle is Carlos Danger. Carlos Danger, keep it clean. Family show. Go ahead.
All right, thank you. Danielle, I've heard you say that you think the Fed is staying higher for longer. With increasing unemployment, is that the straw that might break the Fed's back or and stop higher for longer? Because unemployment is rising, but I don't know if they can stay and hold the line with unemployment, rising and the politicians increasing the pressure on Powell.
Well, so the good news is most politicians aren't so bright. And we have heard an interesting theory come out of Lori Logan, who runs the Dallas Fed. She recently posited that the Fed could start to lower the Fed funds rate, when recession arrives, while continuing to shrink the Fed's balance sheet. Now, think about that for a minute, right? Right now, you've got double tightening. You've got the Fed increasing the Fed funds rate, the cost of money, and you've got the Fed shrinking the balance sheet, pulling liquidity out of the system, which is inherently disinflationary and curtails credit. So here comes Lori Logan, who used to run the markets desk at the New York Fed, knows a thing or two about markets, saying, well, maybe we can do both. So that would actually give you the outgrowth of higher for longer, right? Because the majority of the interest rate increases have come and gone at this point. We get 25 next Wednesday. You might get 25 in September. But right now, we've got the Fed funds rate up to a high enough level that if Powell needed to reduce interest rates to the same extent that he did in 2019 by 250 basis points, he still doesn't get to the zero bound. So that's a good thing. But could you theoretically continue to shrink the balance sheet at the same time, which is, in effect, what higher for longer is all about? I don't know the answer to that question. But politicians would see you lowering borrowing costs, because that's what's going to be visible to a politician who's screaming their bloody head off, because right now you've got 93% of the U.S. population living in a state with rising continuing claims. So politicians are becoming increasingly aware that even though the Bureau of Labor Statistics can't seem to pull the unemployment rate out of its anywhere reasonable, that there's a growing recognition that last September you had 0 states with rising continuing jobless claims. Now you have 46 states, and only one state, the state of Oklahoma, has had since September of last year falling continuing claims year over year. That's data you cannot get around. But would a politician see the nuance? Well, gee, look, the Fed is lowering interest rates, they're easing policy. But if the Fed was still shrinking its balance sheet, which keeps credit on a leash, would a politician be able to decipher that kind of policy? I say we're going to find out, because I think Jay Powell really wants to shrink that balance sheet. So you could see maybe the middle of 2024, the Fed starts lowering interest rates slowly. But if they continue to shrink that balance sheet, all the economists are going to have to throw away all the textbooks and rewrite them, because no central bank on planet Earth has ever run neutral monetary policy, one that negates the other. But that's the potential that we're possibly seeing. And by the way, you pull those interest rates down, all these mortgage-backed securities that have not rolled off the Fed's balance sheet, they can naturally start to play catch up. That would be a good thing. We do not want the Fed involved in the housing market anymore. So I think I more than answered your question. Good one, though.
Very good question. Our CEO is fond of saying it's the best time to be alive. And even if you don't agree with that, it's certainly one of the more interesting times, especially in financial history. Next up is, let's see, Zach of all trades. And then I'm going to get to some of the people who've asked questions in our Twitter feed. Hey Zach, what's up? A question for Danielle.
Yes, sir. Thank you for having me. Pleasure to meet you, Danielle. My question is regarding the economical competition between United States and China for the world currency. For the last 3 years, China has been beating United States in um, real GDP per person when adjusted by price parity, and China also has been beating United States in world trade share. Sorry, I'm out of breath because I'm walking, but beating the United States in world trade share in terms of exports. Um, and in terms of AI, they've already been implementing AI in their education systems. And I remember you saying, I'm glad you said that about AI being used to better our education, because history has shown anytime money was heavily invested in education with a forward looking thoughts, it has resulted in a lagging effect on economic growth. So, with all that being said, with China already implementing AI in their education, even their TikTok apps, children are forbidden to use it past a certain amount of hours, and it only has educational videos on their TikToks for their children. So, would that not give? And then upcoming in September, you have BRICS, which includes China about to introduce a new currency that's backed by gold. With all that happening, would that not show, like, I guess, a leading indicator that China has extreme leverage in terms of actual um, price parity value of an economy and GDP, and potential for taking over the world reserve currency status?
So you've clearly done your homework. You might need to unfollow a few people who are worried about the dollar. Just a friendly suggestion. Um, China's growth has slowed back to a 30-year low. If China had the wherewithal right now to pull to pull the global economy out of recession, it long since would have. That's why Brazil is going to lower interest rates next week. Um, they've got enough money to invest domestically right now to ensure that there's no social strife. But them rising, the yuan's rise, when you make these charts, you actually have to make the scales really small, because China's gone from like 1.45 to like 1.65% of transactions done in yuan. Um, what you need to follow, if you're concerned about this, don't get me wrong, I forced my 4 kids to take Mandarin. They do not like me. On the other hand, if you were in World War II and you spoke German or Japanese, you didn't have to go to the front lines. I got 3 boys. What can I tell you? Only the girl speaks it. There's Murphy for you. But so you have to worry about this long term. But follow the FX market. Follow the biggest market on planet Earth. $7 trillion traded every single day. 87% of which is in dollars. When that figure starts to fall, when currency transactions are no longer some great big number like 87%, then start to get worried. But my God, a few months ago, Saudi Arabia just issued bonds, sovereign debt in dollars. Until the world can wean itself off of issuing debt in dollars, and until the currency markets are no longer 87% dominated by the greenback, we can talk all we want about BRICS and dollar de-dollarization, and it's really sexy, especially at 3 a.m. on Twitter, but it ain't happening until it happens in real life.
Gotcha.
Go ahead.
I was actually referring to over like 2 decades worth of time, not immediate. But yeah, that answered my question. Thank you so much.
Great,
But
great
I would
question.
I would
Go ahead.
just add, remember, the Chinese renminbi is pegged to the US dollar as well, right? So, that, yeah.
Wow. We have put her through the paces, guys, and she's come out just brilliantly. What a fantastic hour. We've got about 16 or so questions that are in the queue. What I'm going to do is I'm just going to @Danielle on Twitter, kind of go through each one so she sees it, and when she's got some time, she'll give you a shout there.
Yeah, I'm
In the
road tripping
Go ahead.
I'm road tripping for 7 hours later today, halfway to the beach. So I'll have some Twitter time on the road. I'm not driving.
That's
I
great.
do know how to tweet and drive, but I'm not doing that today. I promise you.
Fantastic. Well, can't thank you enough for all the time. If you want more from Danielle, get out to her Substack, and of course, quillintelligence.com. There's a bunch of ways you can find her. She's everywhere all the time, and of course on Twitter. And it's just a fantastic follow, and we're very very lucky to have her. Thanks again, Danielle. Stefan, any final words?
No, I'd just like to thank you, Danielle, for taking the time out and joining us, and look forward to circling back in next, not too far distant.
Sure. I look forward to it as well. I'm your biggest cheerleader.
You're
I'm the Truflation cheerleader, so I look forward to next.
I appreciate that. And I'm just down in Austin. So you're up in Dallas, I'm in Austin. So it's only a couple of hours of drive away.
Absolutely. My oldest goes to school there, so I'm there pretty often. I'll come see you during football season.
Look forward to that.
Thanks much.
All right, everyone. Thank you so much. The next Twitter Spaces we've got is on July 26th, this Tuesday, with Jonah Lipton, and right in the midst of the FOMC. We're getting micro there. We're going to get the trader's perspective on what's going on, and we've also got a special guest from the Israeli Blockchain Association. So should be a fun time. We'll see everybody next time. Thanks again to Danielle, Stefan, and all of you who asked questions. Again, I'll add her right now, and so you guys can get answers. Thanks again, everyone. Bye for now.